What is up, everybody? My name is John, and welcome back to the Bootcamp. And today is episode 10 of the Day Trading Bootcamp, and I believe today is the second last episode of the Bootcamp. So if you made it this far, congratulations. You almost know every single confluence required to trade my model, the SYS system, which is the simplest inversion system in the entire space. Today, we are talking about SMT Divergences, which is one of the most important confluences in my model. By now, you should know all about liquidity, and this is kind of the last step you need to being an absolute dog with understanding liquidic targets. That being said, before I get into this episode, make sure you click the link in the description, join my Discord. I live trade in there every single day. My model, the SYS system, is the easiest model to learn in the space. It revolves around inversions and understanding liquidity really well, and believe me, if you follow this bootcamp, you will know just how to do that. So join the link in the description and get ready for this video because this is a big one. But anyways, let's get right into these confluences. All right, everybody. So as you know, we are talking about SMT divergences today. And if you don't know, I trade the NASDAQ NQ, and with NASDAQ comes ES, the S&P 500. And these are two correlated indexes. All right, so what that means is by correlated indexes, I mean one follows the other. So if one reacts off of something, the other is going to react off of something. And before I get into this confluence, let me kind of explain to you why that happens. So with these indexes, the NASDAQ, as you know, is the top 100 tech companies in the United States, and ES is the top 500 companies in the United States. So considering these two have a lot of companies that overlap, they are correlated, and that's how they are correlated. So if one reacts off of something, the other one's going to react. Now, what this means is liquidic targets on one index matters for the other index. So if NASDAQ sweeps a low or fills in a fair value gap, which is a liquidic target, even if ES hasn't or already did and NQ didn't fill in that liquidic target, it applies to both of them. So if one sweeps a liquidic point, it matters for both. You can consider it almost swept on both because there is that SMT in place. The orders were filled on one, so they're also going to be filled on the other, even if on the charts that doesn't appear that way. Now, that being said, there are two forms of SMTs. You have bullish and you have bearish SMTs. What this could look like would be NQ sweeping a low, or not sweeping a low, and ES sweeping a low. ES swept, NQ didn't. You have an SMT there, which you can see clearly by one sweeping and the other one not, and you get a reaction off of that. So you can see reactionary points. It might look like, oh, NQ didn't sweep the low, but ES actually did. So you got to be watching both at the same time. Same thing for a bearish SMT. If you had a high, NQ fails to sweep it, ES sweeps it, you have an SMT at that high. ES is leaning more bullish, NQ is leaning more bearish, but the liquidic orders are filled. They're both going to react. So you might not see NQ actually come up to that high and sweep it. You'll see the reaction off of it. Same thing could be if this is a fair value gap. Let's say NQ doesn't trade into a fair value gap. The fair value gap is down here. ES does trade into the fair value gap. You see ES wick into it and you start to see a reaction out of it. You have an SMT there. Now, SMTs can be at two places, like I said. They can be at lows and highs, or they can be at fair value gaps. And also, one thing to take note of is it doesn't matter which index actually does the sweeping. Whether it's NQ or ES, that doesn't matter. You just know there's a leading and a lagging index, which is something you should be aware of, but it doesn't matter for SMTs. You can flip-flop the order of these. Doesn't matter which one takes what. Now, that being said, just because a tiny high gets filled in on one doesn't matter if it gets filled on the other. We're not worried about any random high or low that gets swept or doesn't get swept. So an example of a prominent low that you have an SMT at would be a session liquidity pool. So if Asia lows get swept on NQ but don't get swept on ES, that's a major SMT to worry about. But if it's this random 1 minute fair value gap or 1 minute high or low and you're like, oh my God, there's an SMT, there's going to be a reaction. No. The only point I really worry about SMTs on the higher time frame would be session liquidity pools or 1 and 4 hour highs and lows or fair value gaps. Other than that, don't get too caught up in the noise. Keep it simple for yourself. Just settle price alerts at certain price levels where you know there's a high time frame liquidity pool. That's where you should worry about SMTs. For now, don't worry about these little tiny SMTs that you see. Now, you may be wondering, John, how do I see two charts at once? How do I watch two charts at once? Well, guess what? It's simple. Go to the top of your trading view and you'll see this little box right up here. You can click this little split icon and you can select the two, and you can have two charts going at once. So you can see I have the S&P pulled up and I have the NASDAQ pulled up. Now, let's get into an on-chart example of an SMT. So I just want you to take a moment, pause this video, and take a look at both of these areas of price that I have on my screen. You'll see it's from the same date, both of them, and just take a look at this general area of price. What do you notice is different between the two of these? Well, what you'll notice is this high right here was never swept out on NQ on Friday the 9th. If you go over to ES and do the same thing, this high from the 7th was swept out on the 9th. You see, ES swept this high, NQ did not sweep this high. What does that tell you? You have an SMT divergence. Beautiful. Okay, so you're going to mark out your SMT. You realize NQ failed to sweep, showing signs of being bearish. ES did sweep and fill in these orders. So you can consider these orders swept on both indexes. You can clearly see, even though NQ came really close to trading and hitting this high, how close were we to this high? Let's check. We were literally 45 ticks, 11 points away from the high. You'd almost see that as like a failure swing, that you should sweep this. Why wouldn't we sweep this high before we sell off? Well, you don't have to because ES swept it. You have an SMT there. You will see we saw a massive reaction off of what seemed like nothingness on NQ, but in reality, that reaction was sponsored by ES sweeping this liquidity, filling in this orders, and sending us lower. Okay, as you know, I always say, you have to say, what story is price telling us? Why should I be concerned about what ES is doing when NQ is doing it? Well, these orders matter for both indexes, so you need to be aware of, does ES look more bullish while NQ is starting to look bearish? If that's the case, you should be monitoring what highs could ES sweep that could cause a reaction to the downside, because NQ looks so bearish, but ES is still looking bullish. Well, let's see if there's a point that we could reject off of on ES, but maybe NQ doesn't quite get there because it's trading lower than ES. You could get an SMT put in there that could give you a confluence to add to your arsenal of confluences for your trade for that day. Now, that being said, this isn't just for liquidity sweeps. Liquidity matters in both directions, not just sweeps. So you obviously use liquidic points for your take profits. So you also have to be aware of SMTs if you're currently in a trade and you have your take profit set at a certain area. If ES sweeps the high that you're targeting on NQ, you're targeting that high for a reason because you know there's a bunch of orders there and your trade might not go any farther past that high. So if ES sweeps that high, you have to realize, okay, this is a problem for my trade. I need to start looking to get out of this position. That being said, one rule I have in my system is if there's an SMT at your take profit, full close the position no matter what. You don't just go break even. You don't just try to hold it because the orders were filled on one index. You don't know if that SMT is going to hold or not. So you should be looking to get out of your position if that happens. This matters in both directions. So you always need to be monitoring both indexes at once, no matter what. One tool that I found makes this super helpful so you don't have to just be staring at two screens at once is if I move my face here and get this out of the way, there's this little tool that you can use on the left side of your screen, this little plus button right here. If you click that, you can add alerts. And what that'll do is whenever ES trades at this price level, it'll fill it and it'll give you a little notification at the bottom of your trading view and it'll alert you that ES filled it. So you can still have one screen open and just know that that alert could trigger and you're going to get that notification. That being said, let's get into an example of an SMT at your take profit. Okay, so let's simulate a hypothetical trade. Let's say you're looking at the charts here and you determine that if we inverse this fair value gap down here, you're going to target these highs for your take profit. So you get ready, you say, okay, we're going to get the inversion here. Let's see if we get an entry. Bang, next candle, you get your inversion, you enter your position. Great, so you set your stop loss and you set your take profit. You're looking to see these highs get ran. And you're just going to see what happens. You got to let your trade play out. You got to see if it'll win, lose, tie, whatever. You got to let this play out. So you enter your position, and next thing you know, price chops around, and it comes up, and it gets super close to hitting your take profit. Look how close we are. Edging take profit. This should hit. There's no reason this trade would fail if you get this close to your take profit. But in reality, after an extended period of time, this trade ends up coming down and stopping you out at break even. Why did your trade fail? Well, guess what? It was because there was an SMT. If you open up ES and you pull up this chart, you'll see this high from the 7th, which you were targeting for your take profit, was filled in and taken on ES. Look at price before this. Price looked about the same. We were just kind of in like a baby uptrend. You were looking for an entry. ES was showing the same thing, but this high was swept on ES. On NQ, this wasn't. So as soon as you see ES hit your draw on liquidity, you know there's an SMT there. You know ES filled in these orders. You know NQ doesn't have to fill in these orders anymore. So at that point, you would just have to close your position when you see this SMT get put in, because clearly that high that got swept was what sponsored this massive sell-off. Now, that being said, SMTs people overcomplicate. They get so confused on, they don't understand them. They don't understand bullish bears. They get so wrapped up in the nitty-gritty details. Stop. Don't. Go to ES. Mark out all the highs and lows and fair value gaps that are relevant to you on the 1 and 4 hour time frame. If one of them gets hit on ES and one of them doesn't on NQ, or vice versa, that's all you need to know. Don't overcomplicate this. High time frame draws on liquidity getting filled in on one and not on the other is all you need to know for SMTs. That is what is important. Don't make a mountain out of a molehill. Don't talk about 1 minute highs, SMT there, this fair value gap inverse, but that one didn't. No. Block out all the noise. Focus on the simple stuff. SMTs. These I use personally. I won't trade without an SMT. It's one of the most probable sweeps on liquidity. If a liquidity is swept on one index and not on the other, it's going to be much more probable that it's going to play out because one is clearly lagging while the other one isn't, showing you that you have that strong draw already and that strong reaction, even without a liquidity pool getting swept. Then once one of them sweeps and the other one doesn't, it's going to sell off. You don't need to wait for both. So SMTs are huge for my model, and I definitely recommend you study them. Go onto your charts, go into bar replay, backtest this. Find SMTs, spot them out, see how price reacts off of them. Liquidity pools matter. That's the biggest confluence in my entire model. So if one index sweeps and these indexes are totally correlated, it's going to blow up everything. So study these, make sure you get these down, backtest this, apply it, and your model will go from a 50% win rate to an 80 just by tossing in SMTs. That being said, that's all I have for today. I don't want to spend too much time on this because I don't want to overcomplicate it. Really, it's not that deep. Look at when I had my beautiful drawing on the charts from the beginning of this episode. Look at that, screenshot it, study it. That's all you need to know. Don't make anything too crazy here. Remember, link in description, live trading in the Discord, my entire model, PDF broken down for free, tons of free resources aside from this bootcamp in that Discord. Great community, no reason you shouldn't join it. Thank you all for tuning into this bootcamp. You are almost there, so stay focused, stay dialed, and make it to the end. And I will see you all in the next episode of the bootcamp.